All right, so we're diving into risk management today.
Yeah, looks like you've been doing a lot of research on this.
I have. There's so much to unpack.
Yeah, it can be a pretty big topic.
That's why we're doing a deep dive so we can really break it down and help people build a solid plan.
Great idea. Because whether you're running a business or just making big decisions, risk is always there.
It is. So, first things first, what exactly is risk management? I mean, we hear the term all the time.
Right, but it can be kind of vague.
Totally. I saw one definition that said it's about figuring out what could go wrong, how bad it would be, and then having a plan.
That's a good starting point. It's like hoping for the best, but preparing for the worst, right?
Exactly. But it's not just about avoiding disaster, is it?
No, it's about being smart with your decisions, even when there's uncertainty, not letting fear paralyze you.
So it's more about being prepared, like having a backup plan just in case.
Exactly. And one of the things you think over was about different types of risks. It's amazing how many there are.
Oh yeah, I was surprised.
And it's easy to overlook some if you're not careful.
For sure. Like there's financial risk, especially with how things are in the markets right now.
Right. And then there are operational risks, things that can go wrong within a company.
And of course, the big strategic risks, like choosing the wrong path for your business.
And those are just a few. There are legal risks, reputation risks, cybersecurity risks, and more.
It seems like risks are everywhere. How do we even begin to tackle all of that?
Well, that's where a risk management process comes in.
Yeah.
And luckily, there are frameworks to help.
Okay, yeah, I saw something about a 5-step process.
Yeah, that's a common one.
It starts with identifying the risks, which seems pretty obvious. Figure out what could go wrong.
But it's more than just making a list of worst case scenarios.
So what else is involved?
You need to systematically gather information. Look at past events, talk to experts, get a full picture.
So be thorough, not just rely on gut feelings.
Exactly. Then you move on to assessing those risks.
And that means what? Figuring out how likely each risk is?
Right, and how bad the consequences would be if it happened.
This is basically ranking them.
Exactly. You don't want to waste time on a small risk when there's a bigger one that could sink the whole ship.
Makes sense. So once you know what the risks are and how serious they are, what's next?
Then you move on to risk mitigation, coming up with strategies to deal with those threats.
That's where it gets interesting. What kind of strategies are there?
Well, there are a lot of options. You can put controls in place, make backup plans, or even transfer the risk to someone else.
Transfer the risk. What does that mean?
It's like insurance. You're paying someone else to take the hit if that risk actually happens.
Ah, that makes sense. So once you have a mitigation plan, are you good to go?
Not quite. Next comes risk monitoring.
Which is what? Keeping an eye on things.
Exactly. You got to make sure your strategies are working and be ready to adjust if new risks come up.
Because things are always changing, right?
All the time. What's a small risk today could be a huge problem tomorrow.
So you got to stay flexible. And what's the last step?
Risk communication. You need to keep everyone in the loop about the risks, the plans, any changes.
Especially if you're working with a team, right?
Absolutely. Everyone needs to be on the same page.
So a team that understands the risks can better spot problems and help fix them.
Exactly. Now, you also pulled some interesting stuff on companies that are good at this, like JP Morgan Chase.
Oh, yeah. I was reading about how they handled the 2008 crisis.
Their chief risk officer made some big moves to reduce risk.
And it helped them when other banks were struggling. Then there was Toyota.
They're known for their quality, and that's partly because of their focus on risk management.
Interesting. So we've covered what risk management is, the different types of risks, the basic process.
You've got a good foundation.
But how do we figure out how much risk is okay for us? Like some people are more cautious than others, right?
That's a great point, and it leads to risk appetite and tolerance.
Okay, tell me more about that.
Risk appetite is how much risk an organization is willing to accept in order to reach its goals.
So it's like your overall comfort level with risk?
Yeah, that's a good way to put it. Risk tolerance is a bit more specific.
How so?
It's about setting limits for how far you're willing to deviate from your goals. Like, okay, we'll go this far, but no further.
So it's like drawing a line in the sand.
Exactly. Having both risk appetite and tolerance gives you a framework for making decisions.
So everyone knows the boundaries
Yeah.
and makes choices that fit the overall strategy.
Right. Now, figuring out those things, your appetite and tolerance.
Is there like a magic formula?
There are tools and techniques, but it's not just about numbers.
It's about understanding your values and goals.
Right. And how much risk you can actually handle.
So if you're starting out with limited resources, you'd probably have a lower risk tolerance than a huge company.
Exactly. And remember, your appetite and tolerance can change over time.
Like as your business grows or market conditions change.
Exactly. You need to constantly reevaluate. It's not a one-time thing.
Makes sense. So risk management is about staying flexible and adapting,
Absolutely. And that reminds me, we also need to talk about building a risk-aware culture.
right? That was in the research too.
It's great to have policies, but if your team isn't on board, they won't be effective.
So it's not just about writing things down.
It's about getting everyone to buy in.
How do you do that?
A risk-aware culture is where everyone understands that risk matters, and they participate in the process.
So everyone's involved in spotting risks and dealing with them.
Exactly. And to create that culture, you need strong leadership.
Leaders who set a good example.
Right. Leaders who prioritize risk management, encourage communication, and are proactive.
So they walk the walk, not just talk the talk.
Precisely. Make risk management part of your everyday operations.
Okay, so we know what risk management is, the different types of risks, the process, and the importance of culture.
That's a lot, but we're just getting started.
Exactly. And now I want to talk about specific strategies for mitigating risk. I know there are a bunch of techniques, but where do we even begin?
You've got some great stuff in your research that breaks down the main approaches.
Oh yeah, I remember reading about those.
They usually talk about 5 categories: avoidance, reduction, transference, acceptance, and sharing.
Okay, yeah, those ring a bell. Avoidance seems pretty simple. Just don't do risky things.
Like, if you're worried about getting hacked, you might avoid storing sensitive data in the cloud.
Right, makes sense.
Yeah.
But you can't always avoid risk, can you?
No, sometimes you need to take some risks to reach your goals. That's where reduction comes in.
So you try to minimize the risk instead of completely avoiding it.
Exactly. Like if you have to store data in the cloud, you make sure it's encrypted.
Makes sense. And then there's transference, which we talked about earlier, like with insurance.
Right, passing the risk on to someone else.
But what about acceptance? That sounds like you're just giving up.
No, not really. Acceptance is about choosing to live with a risk because trying to avoid it would cost more than the risk itself.
So it's a calculated decision.
Exactly. It doesn't mean ignoring the risk. You still monitor it, but you accept that it's there.
Okay, that makes sense. It's about picking your battles. And then there's risk sharing, which sounds kind of like teamwork.
It is. It means spreading the risk across multiple parties, like in a joint venture.
So everyone shares the burden.
Right. It can reduce the impact if something goes wrong.
So we've got avoidance, reduction, transference, acceptance, and sharing. It's like a whole toolkit.
That's a good way to think about it.
But how do we know which tool to use for which risk?
That's the tricky part. There's no easy answer.
It depends on the situation.
Exactly. The
Yeah.
nature of the risk, the potential consequences, the cost of mitigation, and of course, your risk appetite.
Right, right. It's like a puzzle.
You got to figure out which pieces fit together.
Speaking of tools, I also saw some stuff about risk management software and templates.
Yeah, those can be really helpful.
It seems like they could help make the process more efficient.
Absolutely. There are simple tools and more complex systems. You choose what's right for you.
Okay, so we've covered a lot. What risk management is, the types of risks, the process, even some strategies.
We're making good progress.
But we also need to be realistic. Risk management can be tough.
It can definitely be challenging.
What are some of the challenges people might face?
Well, one of the biggest ones is identifying risks that you don't even know about.
It's like trying to predict the future.
Right. You
Yeah.
can't prepare for everything.
And then there are the practical limitations like time, money, expertise.
Those are very real concerns, especially for smaller businesses.
Definitely. And don't forget about people being resistant to change.
Oh, yeah, that's a big one. New procedures can disrupt how people are used to doing things.
Right, it can cause pushback. Change is scary sometimes.
It is. And then there's the fact that risks are often interconnected.
Like one risk can trigger another.
Exactly. So it's like a domino effect.
And of course, there's the challenge of keeping up with regulations.
Absolutely. Those are constantly changing.
So we've got unknown risks, limited resources, resistance to change, interconnected risks, and changing regulations.
It sounds overwhelming, I know.
It kind of is. So how do we deal with all that without just giving up?
The key is to be proactive. Stay aware, adapt to changes, and use the tools and techniques we've talked about.
So be prepared and make good decisions.
Exactly. And remember, effective risk management is a journey.
It's about continuous learning and improvement.
Right. Now, you also found some information on quantitative versus qualitative risk assessment.
Yeah, I was a little confused about those.
Qualitative risk assessment is more about using your judgment.
Okay, like your intuition and experience.
Exactly. It's good for a quick overview and prioritizing the most serious risks.
And what about quantitative assessment?
That's where you use numbers and data.
So it's more objective.
Exactly. You use historical data, statistical analysis, mathematical models.
So it's like two different lenses for looking at risk. One for a quick view, one for a deeper analysis.
That's a good way to put it.
So which approach is better?
It depends on the situation. Sometimes a quick qualitative assessment is enough.
And sometimes you need the hard numbers.
Exactly. You choose the right tool for the job.
And sometimes you might even use both together.
Absolutely. To get a more complete understanding of the risks.
Makes sense. Now, there were also those terms, SLE and ALE, which I found a bit confusing.
Single loss expectancy and annualized loss expectancy.
Yeah, those. I think I get the basic idea, but can you explain them?
Sure. SLE is the potential financial loss from a single event.
Like, if your warehouse burns down, how much would it cost to rebuild?
Exactly. And ALE takes that a step further. It considers how often that event might happen in a year.
So if fires in your industry happen once every 5 years, you can calculate your potential yearly loss from fire.
Precisely. And knowing your SLE and ALE can help you decide how to mitigate risks.
Like if the ALE is really high, you might be more willing to spend money on prevention.
Exactly. It helps you weigh the cost versus the benefit.
What about safeguards? I remember reading about those.
Yes. Safeguards are the things you put in place to reduce risk.
Like sprinkler systems or strong passwords.
Right. And the value of a safeguard is how much it reduces your potential loss.
So if a sprinkler system reduces fire damage by $10,000, but only costs $1,000, it's a good investment.
Exactly. It's all about return on investment.
So we've got SLE, ALE, and the value of safeguards. All tools to help us make informed decisions.
They're all part of the process.
But what about things that are harder to measure? Like reputation or customer trust?
Ah, yes. The intangibles.
How do we factor those into risk analysis?
That's a great question. Quantitative analysis can't capture everything.
Because some things are hard to put a price tag on.
Exactly. But that doesn't mean they're not important.
So it's about finding the right balance between numbers and judgment.
Right. Use data to guide your decisions, but also acknowledge those subjective factors.
The art and science of risk management.
I like that. Now, something else you mentioned in your research was documentation.
Yeah, I remember that being emphasized.
It's important to document your risk assessments and decisions.
So you don't forget later.
Exactly. And so that others can understand your reasoning.
That's where the risk register comes in, right?
Exactly. It's a central place to keep track of all your risk-related information.
Like a risk management Bible.
That's a good way to put it. Now, you also highlighted the importance of communication when it comes to risk.
Right, that seemed crucial.
It is. Everyone needs to be on the same page, and that requires clear communication.
Because if people don't understand the risks, they can't help manage them.
Exactly. Effective risk communication builds trust and encourages people to take ownership.
So it's about explaining things in a way that everyone can understand.
Right. Avoid jargon and make the information engaging.
It's like telling a story about the risks.
That's a great analogy. And remember to tailor your communication to your audience.
Different people need different messages.
Exactly. Consider their level of understanding and their role in the process.
Okay, so we've talked about a lot today. From theory to practice, individual risks to organizational culture.
It's been a great discussion.
I feel like I've learned a lot.
Me too. And before we wrap up, I want to leave you with one final thought to think about. Think about this. It's not about eliminating risk entirely. You can't do that. And it's not even the goal.
Right, you have to accept that there's always going to be some risk.
Exactly. It's about making decisions you feel good about, even when you don't have all the answers.
And having a structured approach can help with that, right?
Absolutely. It makes it less overwhelming.
I remember seeing that simple 3-step process for risk assessment.
Oh, yeah. That one's a classic. Identify, analyze, evaluate.
Easy to remember. And they even had that Excel template to help you organize everything.
And you can use it for anything. Launching a product, a new marketing campaign, even personal decisions.
I like that. It makes risk management seem less intimidating, like anyone can do it.
Exactly. And remember the different types of analysis. Qualitative and quantitative?
Yeah, those were helpful. Sometimes you just need a quick gut check.
Right. That's where qualitative comes in. But sometimes you need the hard data.
And that's when you go quantitative. I like that they showed examples of both.
Yeah, like how to create a risk matrix and calculate those things, SLE and ALE.
And they emphasized documenting your assumptions, which I thought was interesting.
Oh, that's so important. Even with numbers, there's still some judgment involved.
So be transparent about your thinking, which makes sense because at the end of the day, risk management is about making decisions.
Exactly. And you need solid information to make good decisions.
And you need to communicate that information effectively.
Absolutely. Make it clear, concise, and engaging.
Tell a story people will actually listen to.
That's the idea. Now, another thing we talked about was risk mitigation strategies.
Yeah, all those different options. It's like having a whole arsenal.
Avoidance, reduction, transference, acceptance, sharing. So many tools to choose from.
It's like a game of strategy, figuring out the best moves to protect yourself.
And part of that strategy is setting risk thresholds.
Right, I remember that. Can you remind me what those are again?
Basically, it's deciding how much risk you're willing to take in a certain area.
Like drawing a line and saying, nope, not going past this.
Exactly. And those thresholds can be based on all sorts of things: finances, regulations, even ethics.
So they guide your decision-making and keep you within acceptable limits.
Right, like guardrails to keep you on track. Not too much risk, but not too little either.
So you don't miss out on opportunities.
Exactly. And remember, those thresholds aren't set in stone. You have to reevaluate them as things change.
Because your business changes, the market changes, regulations change.
Right. You got to stay flexible and adjust your risk tolerance as needed.
So risk management is an ongoing process, always learning and adapting.
That's the key takeaway. It's not a one-time thing, it's a journey.
Well, I feel like we've covered a lot of ground on that journey today.
We have, from the basics to some pretty advanced stuff.
And I think our listeners are now well equipped to start tackling risk management in their own lives.
I hope so. Remember, it's all about being aware, being prepared, and making smart decisions, even when things are uncertain.
Great advice. So keep learning, keep asking questions, and you'll be able to achieve your goals with confidence.